Hey traders, this is Blake Morrow with Traders Summit, and I have Mr. Jim Welsh from Macro Tides. He's going to actually figure all this stuff out because, man, I have to say, stocks all-time highs, gold all-time
Yep.
highs,
Yep.
and the dollar has been up, down,
Yeah.
all week. It's just been really, really sloppy. Hopefully, you can help make sense of all this, Jim. And I know you've been in Montana and you were on
Yes, I have.
vacation, so
Yeah,
welcome back. But
yeah.
what have
Thanks.
you what conclusions have you come to after being away for a while?
Well, I'm trying to get tuned in the last 2 hours. You know, well, I think, in terms of news of the week, I would say the China stimulus plan was probably the news that moved more markets more. I think it contributed to some strength in gold. And I think it helped equities in the sense of, okay, that's another plus for economic growth. GDP revision came out, fine. So, again, to me, the China news was probably the most significant, and we're going to talk about that in a couple minutes. Beyond that, nothing from my perspective has truly changed in terms of, I think the S&P is nearing at least a short-term high. I think gold is also nearing a high. What's happened is things just have extended a bit more than I thought they would. But I don't think things have materially changed since last week in terms of my expectation for markets.
I want to say, Jim, that markets always they always surprise me because they always tend to go further than you expect. You expect them to go a certain
Yeah.
certain distance, and then
And gold is one of those markets that would be
it's
the poster child for that statement.
exactly. So we've seen this
Yeah.
massive event, and you're right. The China news has been big. We've seen a big response in the China 50. I mean, that market's up. I have to go look percentage wise. Maybe I can pull up the
Double
chart here
digits, I
for it.
think.
It has been absolutely crazy. I'll pull up that chart here in just a second. But what makes it so big? And I'm going to go to your slides here in 1 second. I just
Yeah.
want to grab the Chinese market, and on a percentage basis, and you'll be able to see it here. Let me go show you. From a percentage basis, I mean, the Chinese markets ever since announcing stimulus is up 20%.
Oh, okay. I
Yeah,
knew it
you
was
can,
double digits. I didn't know it was that double digit.
yeah,
Yeah.
20% incline just from
Mm.
this week. I mean, that's big because how many institutions are, just underweight
No
China.
question. Yep, you're right. And there was, I think, a fair amount of shorts that had been established because all the news up until this week has really been downbeat in terms of economic growth, consumer spending. It's funny, I'm going to be writing the October macro tides, and I wanted to write about China because they've got some serious problems. And what they, I think, acknowledged this week is, yeah, those problems are real. They're not going away, and we got to do something about it. So, um, will what they've done and what they will do more so, will that really eliminate the challenges that China faces? I'm skeptical because, as people say, demographics are destiny. And the China population peaked about 5 to 8 within the last 5 to 8 years. Their working force population is shrinking. If you look at going out the next handful of decades, 30 to 50 years, their demographics are really bad.
Well,
And
well,
again, it
well,
relates
but can't you say the same thing for like US as well?
not anywhere near as bad.
Okay.
And besides, we just supplemented our population by 10 million people or so.
I
China,
guess
I don't
that's
think
a good
I
point.
think China has actually closed borders. I don't know, maybe they're crazy enough, but to do that. But no, the point being, Blake, is in 1979 they had the one-child policy because they wanted to stem the amount of population growth.
Yeah.
And then starting around 2015, they tried to reverse that policy, offering incentives and encouraging couples to have more than one child. It isn't happening. And so the net result is their population is going to age very, very quickly, which means the dependency ratio, in other words, young workers versus the older folks, is really going to increase significantly. So demographics is destiny because GDP growth comes from two things: productivity growth and population growth, people entering the labor force.
Yeah.
The other issue is that the average Chinese person has, I think, 70% of their net worth is real estate. Now, it's big in the US, but it's nowhere near what it is in China. They don't have a lot of exposure to their stock market. And home prices have been declining. And the net result is Chinese people aren't spending.
Yeah.
So what China is doing is, in the past, they could always just do huge infrastructure bills, like spending and building stuff. They can't really do that anymore. They've got cities that are empty, and relying on real estate. Local governments have a lot of debt. And in the past, what they did, Blake, is they would sell land to the developers to generate revenue. Well, guess that game's kind of over, and they're sitting with a lot of debt. So, my point is, what China now has adopted is this: we're going to manufacture our way out of this problem, and we're going to ship a lot of stuff to Europe in terms of EVs and a lot of other products in the US. But unfortunately, there's an anti-China sentiment, not just here in the US, but over in Europe. So I think that China faces challenges in terms of, we're going to manufacture a bunch of stuff and ship it. I think we're in a place where economic growth, the pie is shrinking. It's not growing as fast. And that means you get a rise of protectionism. And we've seen it here in terms of tariffs, both candidates talking about tariffs of some magnitude, Trump across the board, which is a little crazy. And I think it's stupid, not to put too fine a point on it. But Europe is also reacting negatively to, gee whiz, you're going to solve your economic problem by creating one here? I don't think so. So they've got some real problems as we go out longer term. Short term, doing what they're doing with the stimulus is going to be beneficial for the financial markets. And that's obviously been seen in terms of the Chinese stock market, Hong Kong. Personally, I would wait for a pullback. I wouldn't chase it here.
Yeah.
I think you're going to get some kind of a retracement move. It may not be very deep. If it's up 20%, maybe it pulls back 5%, to 8% would be my guess. So anyway, that's the whole China thing. But again, their longer term problems, I think, are overwhelming.
Well, Jim,
and the danger.
Go ahead. I'm sorry.
One last thought. When an animal has been wounded or someone is in a corner, that's when they're most dangerous. So China has these long-term structural problems, and that will feed into unrest. The youth unemployment rate has been moving up pretty aggressively. My point is, typically what governments do in that situation is start a war. So to me, it's not if China is going to move into Taiwan. It's just a question of when, because I just think that that's how you distract people. So to me, again, this is one of the other negatives. I think we're, on the doorstep of a secular bear market, and there are a lot of things that are going to contribute to that. And China is just one of the pieces of the puzzle.
Well, Jim, let's get into some of the charts that you brought in. The first one was is regarding China stimulus, and this is their lending facility interest rate. As you can see, it's come down quite aggressively. So what do you make of all this?
Well, what they're going to try to do is spur lending, and they're pumping a chunk of money into the banking system so they can do more lending. And it's just classic monetary stimulus to try to get the economy, give it a jolt to get it going again. Again, the problem with real estate, I don't think they're going to be able to solve that. And if real estate prices continue to soften, the average Chinese person, I don't think is going to be like, oh, okay, they cut rates. I don't care. My house is losing value. Or the three homes I own are losing value.
Right.
But for the stock market, everyone's going to respond to the policy switch. And so I think, Chinese stocks will rally more. I obviously being gone, I haven't been able to dive into that as deeply as I will, in terms of, okay, how far could they rally? I just haven't had a chance to review all the charts yet.
Got it. Okay. Well, let's continue on, Jim. And here's the next chart of Powell. Downward
Yeah.
revisions on job growth. Tell us why you brought us this chart.
Well, because, as we've talked, the labor market has become the key driver, not inflation. And the Fed and Powell, various members have told us that really over the last 2, 3 months, I think fairly clearly. And one of the reasons they went 50 instead of 25 was the revisions that the Labor Department came up with. In other words, they shaved off over 800,000 jobs in the prior 12 months. Fairly significant. I think it amounted to almost 70,000 jobs per month. So that was another thing where, Powell and the other FOMC members are looking at, okay, the labor market, yeah, unemployment rates up, but we can explain some of that away from an increase in supply of workers. But these downward revisions, I think, is like, okay, we need to go a little bit more. And therefore, it just highlights that the labor market is going to be the driver of rate cuts going forward. I still think with GDP still hovering at around 3%, I think the hawks are going to be more inclined to go 25 basis points the next two meetings. But if we get a sour employment report for September, like around 100,000 or something like that, well, that's going to make a big difference. Again, the Fed is looking at the labor market and in effect saying, okay, it's loosening up. It will loosen more. We don't want it to loosen too much. We don't want the unemployment rate to move up too aggressively. So, but this is the key. And again, Powell is telegraphing, what they're really focused on. And that means that we have to be focused on it too.
All right. Well, I'll tell you one thing I am focused on, Jim, is what's happening in the bond market. So it seems like yields are starting to move higher.
Right.
TLT has moved lower as a result. Do
Right.
you think that downward move is going to continue?
I think there's a chance of it. I mean, when we spoke a week ago, I noted that, okay, the Fed cut the funds rate and yet treasury yields went up. And the week prior, I'm like, okay, I think we're getting near a high in terms of TLT, bond yields bottoming out. And ironically, I had a stop in at 97, or pardon me, 99.69, and it got triggered on Fed day. So here's the Fed, somewhat a little bit of a surprise cutting 50, and treasury yields have been going up. I'm not confident or certain that this downward, in bond prices, yields ticking up, I'm not sure it's done yet. I think there's a chance we could see a little bit of bounce off that green line that it's come down to, but I think there's potentially it can drop down to the lower line, which is closer, I think, to about 96.50. So, unfortunately, the out was pretty good in terms of long from, I think, 91.13 and got out, 99.69 to 99.93 on one.
So you've called that one pretty well, but I know you had expected even a further rally in TLT. Is that kind of on hold, or
I'm
is this?
glad. No, I'm glad you asked.
Okay.
There can be a case to be made that the counter trend rally off the October low last year is over. All right.
Okay.
I'm not in that camp yet. I mean, I still think, and this is predicated obviously on my economic outlook, I think the economy is going to slow more as we go forward. And if that proves to be the case, I still think TLT can rally to 105 to 109. And if we actually do go into a real recession, 119 is possible. But
Just
from a probability standpoint, I still think, 90, the 105 to 109 is still a target I've had since last October.
okay.
So,
So, well, then if U.S. economic data stays strong through the end of the year, then it's entirely possible we continue to see a move lower in TLT as yields continue higher. Is that correct?
yeah, I mean, if it got below the 94 level on TLT, then I'd have to look at a chart of the 10-year to see what that equates to.
Yeah.
That would start to raise some questions. about, okay, maybe the economy's not going into recession and everything's going to be copacetic. And guess what? The Fed's not going to raise or lower rates as aggressively in that environment as Wall Street's expecting, and blah, 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 blah.
Okay.
Cross that bridge when we get there.
Yeah, we will have to. All right, so your next chart that you brought up is the semiconductor. No, I'm sorry, the S&P.
Yeah.
So you have the
And
S&P
so,
here, and we continue to grind out all-time highs. Actually, Dow was just
yeah,
at all-time highs this morning.
yeah. I mean, when we talked last week, the S&P was at 5733. So, yeah, it's higher. Is it higher by a whole lot? No. I still think we're nearing the end of the move up from the low at 5119 on August 5th. Uh, you know, I think you might get a little bit of getting above 5767 almost looks like you need to do that to maybe complete the pattern again. The other thing I'll point out is the red 5-day exponential moving average is still above the green line, which is the 13. So those are the things that, okay, gee, I think we're near a high. Well, what's the proof? Well, you need to see the 5-day cross below the 13, and you can see, from 2-3 weeks ago, after the S&P dropped to 5407, those moving averages have remained positive. And that's, to me, again, this is one of the things where you're blending technical analysis fundamentals is, all right, yep, I think the economy is going to slow, blah, blah, blah. But in the near term, until we see more weakness appear, and, I didn't have time to put some of the other indicators I used, we're starting to see some signs that peak momentum on this move is behind us. And now what we're doing is going to chop around and probably build more of a top before we see that pullback take place.
Okay. So the next chart you brought up is the semiconductor index. Now, NVIDIA, I know you didn't bring the chart here, but NVIDIA turned from some pretty key levels of resistance yesterday. And I know you were traveling, so it was there's bad news out of SMCI, and NVIDIA turned right at the same time. So it looks like that might coincide with the chart that you're bringing us here.
Yeah, I mean, I've been waiting and watching this, Blake, on the idea, like, you know what? I think the semis are going to rally above, and this is the ETF SMH, rally above that 253.30. In other words, an A up, B down to the 213, and get a C up, which we completed yesterday. And what that implies to me is I have it labeled, the decline from 283 down to 200 was either wave one of a much bigger decline, or it's wave A. And this 3-wave rally up to yesterday's high is a B wave, and then we're going to see a decline. Well, SMH dropped 83 points. What's 83 points from 255? I mean, with wave C and A being equal. So to me, this is another reason why I think the S&P is near a high, is because I think the semiconductors had a very sharp break and then have had an ABC retracement rally, and I think they're going to head south. So if that happens, that'll pull all of the tech stocks down again. And obviously their weighting in the S&P is such that they're going to drag the S&P down with it. If you look at the Russell, I didn't have time to put that chart. That chart does not look very good either, the Russell 2000. So it looks like it had a counter trend rally, much like SMH, and it's been way weaker this week than the S&P. So again, to me, there are signs underneath the surface. Yeah, we're making new all-time highs. It's great. And the Dow's making new highs. Yeah, in terms of the S&P, it's marginal relative to when we talked on the 18th last week. And this pattern too is just all implies that we're setting up, I think, for another correction of some magnitude. What will cause it? I have no idea. But the patterns look pretty, from my perspective, I'm convinced.
All right. Well, one thing that has been very convincing has been this rally in gold. Gold has just rallied significantly.
Yep.
But it looks like you've got it marked up as a wave 5. I know you were looking for
I did that.
5.
I did that a week ago too, Blake. So let's take that with a grain of salt.
Okay.
No, all along, when we were doing that chop and chop and chop, and my thought was we're going to a higher high, 2,600 is possible. So obviously we've rallied another 3%, approximately above 2,600. But the reasons why I was looking for a high was things like positioning. A lot of people are long gold, sentiment, people are very bullish gold, and gold can and does extend, especially in wave five. So I don't think that from my perspective, I think there's a pullback coming. It's going to come from a higher level. So the first target becomes 24.74 because that was the most recent low. And then I think that 23.50 is still a possibility. It's not going to happen quickly or overnight, but I think that's what's possible. Again, the 5 and 13 exponential moving averages, the red line versus the green. Hey, it's in other words, near-term trend is positive. Trend is up, but we shall see.
All right. Well, the last chart is the dollar, and this one it's been a very frustrating one for me this week because we have gone up and down and up.
Yeah, a
and
lot
down.
of choppiness.
It was the most choppy dollar trading week I think we've had, and I know it's end of month flows and a lot of back and forth data. But what do you make of this level we're at? Because you've been for a weaker dollar for a while, so it continues to weaken.
Yes. Now I think as I have it labeled there, that low at 100.51 was wave 3. And we had a bounce to 101.92. I think that's the first part of wave 4, wave 8. The way it's been dropping, you can see to your point and experience, it's chopping all over the place. The net loss isn't all that much. It's just, all the intraday volatility. If you look at the RSI at the bottom panel there, Blake, you can see that at the bottom at 100.51, we're below that on numerous closes, but the RSI is diverging positively. All right. So what I said a week ago was I think the dollar, that you had wave A up to the 101.92. This pullback is a B. I think the dollar is in a position where you could get a pop toward the 101.92. And I think realistically, or more likely, is it should take that out by a little bit. And it's grinding lower and you're getting divergences. Sentiment is very negative, understandably so, about the dollar. So what I see once in a while is how things kind of fall in line. If the dollar does indeed rally, I don't think that would be a positive for treasury yields. It wouldn't be a positive for gold. And again, I think other dynamics are more important for the stock market. So, to me, we're at this place where I think things are setting up for a reaction to the trends that we've seen over the last few weeks in all the markets. Dollar's been down. I think it rallies. Gold pulls back. Bond prices pull back a bit more. And I think, again, if the semiconductor pattern is correct, there's no way. I believe the S&P is set up for a pullback.
Okay. Well, the thing about talking about the dollar here, even if the dollar rallied back above 102 or towards 102, you said it probably wouldn't coincide with the bond market selling off.
No, it would. Okay. In other words, if the dollar strengthens, it's probably going to be because economic data comes in better than expected.
Okay.
Which removes maybe one of the cuts. We got an employment report next Friday.
Yeah, I was just going to mention we do have NFP next Friday, and we got a lot of
So you get another decent number, 150 or whatever else. Well, that would definitely be a tailwind for the dollar. So again, I'm just going based on what it looks showing us in terms of the chart patterns implies what we've been talking about. Dollar gets a bounce, gold pulls back, treasury yields go up, TLT goes down again. But if we do get that pop in the dollar, Blake, that will complete wave 4, which then means wave 5 to a lower low is coming in the dollar. So, let's put it in a bigger frame, that, all right, yeah, you may get a strength up to 102 or so, but that's not going to negate the intermediate trend, which I believe is down. Well, I actually think the longer trend is down too.
Well, Jim, I want to say it's really nice to have you back, and it's nice to get your guidance. And I know you did this last minute, trying to get everything get back up to speed. But thank you for spending your time with us. And if you guys and gals enjoyed having Jim here, and remember, he did a pop-up surprise interview last week.
A week ago Thursday, yeah.
Make sure you give him a big thumbs up. Subscribe to his channel.
You just can't hide, from me. I'm gonna show up one way or the other.
Well, Jim, thank you so much for spending your time with us. And guys, gals, make sure you email Jim at jimwelshmacro@gmail.com and check out macrotides.com. So, Jim, thank you so much for your time. We'll see you next week.
Thank you, Blake. Have a good weekend.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.